All right, Ben, you want to go ahead and introduce yourself and kind of cover what we are going to go through today?
Sure. Thanks, Kaylee. Yes, I'm Ben Platt. I am the founder and CEO of Tembo CPAs, the firm for entrepreneurs. And we had a lot of legislation, a big piece of legislation get passed recently, the One Big Beautiful Bill, OBBB, or however you want to refer to it, here recently, just in the last week or so. And there's a lot of new tax implications to unpack from that. Some of those affect entrepreneurs, some of those affect individuals, some affect both. There's some estate and gift implications. So yeah, there's a lot to talk about, and I'm definitely excited to be here talking with you about it today. So let's dive in.
Yeah, let's do it. So let's just dive right into it on the entrepreneur side. What is the biggest impact that the OBBB has made on entrepreneurs?
We're gonna have to get used to saying
I
the
know.
OBBB. Yeah, I think so. The biggest impact on entrepreneurs, from my perspective, I think, is the qualified business income deduction. So this was a new deduction, completely new tax law introduced in 2018. Um, it was meant to provide some parity between the lower C Corp tax rates and the tax implications on pass-through entities. Pass-through entities being like S corporations and partnerships and LLCs that are treated as one or the other. So that began in 2018. And it was supposed to sunset at the end of this year, at the end of 2025. It was going to go away. And for entrepreneurs, that was going to be bad because it's a 20% deduction that you get on the pass through income from your business entity. So if your business entity is passing through $100,000 a year of net income to your individual tax return, there was a 20% deduction, or $20,000 in that example, that you get without having to spend any money for it, right? Most deductions, you have to spend money to get the deduction. So you get that deduction without having to spend any money. And that was going to sunset at the end of 2025. So one of the big pieces of the Big Beautiful Bill was to make that permanent. So it's not being extended for, 3 more years or 4 more years or whatever, but it is now a permanent piece of the tax code. That is going to help entrepreneurs in a big way plan for how they operate their business and what the tax implications of being an entrepreneur are in the upcoming years. Um, and, I mean, when we're working with, so in terms of how do we work with entrepreneurs and the qualified business income deduction, so we are looking to maximize that deduction. Again, it's a deduction that you don't have to spend money for. And if you don't have to spend money for it, you definitely want to maximize it. The ways that you maximize it are to make sure that the limitations that apply to that deduction aren't restricting you. So we want to make sure that you have all the pass-through income that you possibly can. We want to make sure that the wage limitation is met. The asset, there's a percentage of asset, unadjusted cost basis of assets limitation that might apply. So we want to make sure that all of those limitations are handled and allow for the largest qualified business income deduction that our entrepreneurial clients can deduct. So that's what I think is the biggest impact, although there's many other things to discuss.
That's awesome. That's a lot to unpack. I love it. Lots of information. So how did this bill impact depreciation? And then is there anything in there that might be able to make depreciation exciting for an entrepreneur?
Um, well, I don't know that depreciation is ever going to be super exciting for an entrepreneur, but if you're a big tax nerd like me, there's some pretty cool pieces of the OBBB that impact depreciation. So the first and maybe biggest thing is some people may be aware of the 100% bonus depreciation or just bonus depreciation. This was introduced also back in 2018. And in the first few years, it was 100%. So if you went out and bought a piece of equipment for your business, you could write off 100% of the cost of that equipment in the year that you purchased it. So, like we work with some well drillers, for instance, and they had to buy a new well drilling rig that was like $600,000. they were able to write off 100% of the purchase price of that in the year that they purchased it. And one of the nice things about the bonus depreciation is that it can create losses. So when it comes to depreciation and first year expensing of new acquisitions, Section 179 has been around for a long, long time. I think even before I began my career as a public accountant, Section 179 was around. And that law also allows for first year deductions, but there's limitations applied with it. And one of those limitations is that you cannot create a loss with Section 179, okay? And bonus depreciation allows you to create losses, which is pretty cool because then you can create a loss in one business entity that can offset the income in another business entity, something we never could do with Section 179. And it's one of the great tools that we have with bonus depreciation. Over the last few years, because of this phase out that was in place from the 2018 tax law, the bonus depreciation has been phasing down from 100% to 80% to 60% to 40%. This was going to be the last year of bonus depreciation in 2025, and it was at 20% or 40%. So if you spent $100,000 on a piece of equipment, you could only first year depreciate $40,000. You still had Section 179 available to you, and so you could use that to depreciate all of it. But it just didn't have as much flexibility because of the limitation. The other thing that they passed in this OBBB is with respect to Section 179, and they've increased the limits on Section 179. And they've this is so it's a $2.5 million deduction now. I think it was 1.9 prior to that, and it's a $4 million phase out. I think it used to be 3.1 million. Meaning if you spent more than 3.1 million, or now if you spend more than 4 million, you can't use the Section 179 or it starts phasing out. And you couldn't ever depreciate more than, like right now, 2.5 million. So they've increased those limits, but then when you combine the bonus depreciation, if you're running a plant, and you're going to spend $10 million on machinery and equipment, you can use bonus depreciation to quickly depreciate that. And really the whole advantage of that, I mean, if you think about it, like depreciation, you're going to get depreciation no matter what, right? Even if you don't use first year depreciation. If you buy a piece of equipment and it depreciates over 5 years, you're going to get the full expense of that equipment. The advantage of bonus depreciation, the advantage of Section 179 depreciation, is that you get that deduction faster. You get that deduction right now in the year that you purchase it. And in many cases, the tax savings that you achieve on the purchase of that equipment and placing it in service and getting the first year bonus depreciation or Section 179 depreciation, the money that you save in tax is oftentimes similar to the amount of money that you put down on it, right? Because you can finance equipment and still bonus depreciate it. So if it saves you 30% tax and you put 30% down, basically the IRS just funded your down payment, right? And then you pay the payments from then on. From a financial perspective, it's really about time value of money, though, right? You would rather take a tax deduction now than a tax deduction later, all things being equal, because the value of money now is worth more than the value of money in the future. So that's the real reason that we really look to depreciate things quickly. The other thing is that it just gives us a lot of flexibility. There have certainly been situations where we elected out of bonus depreciation and we've elected out of Section 179 and said, no, we actually don't want to take the depreciation this year because we know next year's income or the year after that is going to be higher. It's going to be taxed at a higher tax rate. And I'd rather have a deduction apply in a higher tax rate than against a lower tax rate, right? Because it's going to save us more tax dollars if we're getting the deduction at a higher rate. All of this basically just gives us a whole lot more flexibility in terms of the planning that we're going to do. And so we're as excited as you can possibly be about depreciation and what the implications are from the new bill.
Yeah, we love flexibility.
That's right.
Um, can you touch a little bit on the 174 R&D expense problem, what that is, and then is the OBBB possibly going to fix that problem?
Yeah, no, that's a great question. So Section 174 deals with what they call research and experimental expenses. Everybody calls it R&D expense for short, right? So it deals with R&D, and Yeah, there's some companies that are like you would just think of, okay, that company has a lot of R&D expense, right? Like a software company is the classic example. If you're building a new piece of software, you're hiring programmers, you're buying other software, and paying for servers, etc. To develop a new application. Um, all of that falls under this research and development or research and experimental expenses, falls under Section 174. Now, oddly, in 2022, there was a change made in the tax law that forced companies that were incurring expenses that were subject to Section 174 to have to capitalize those expenses, okay, and amortize them over 6 years, even if those expenses were something as ordinary as salaries and wages. So I'll give you an example. We had a software client who had in prior years, a handful of employees who were working on a research project for their software platform. Okay. And I don't remember the numbers off the top of my head, but let's just say that they were spending about $600,000 a year in those wages, right? And the thing about software companies is that while you're building the software company, while you're doing all this research, you usually aren't generating a whole lot of revenue, right? Maybe you're breaking even. And in this case, this company was breaking even, right? So they had these $600,000 in wages that they were paying out for R&D. And in the 2022 law, what ended up happening was that you couldn't deduct the $600,000 in wages. You had to capitalize it, amortize it over 6 years, which meant they could only actually deduct $100,000. So this was a company that's breaking even. Their $600,000 deduction got replaced by a $100,000 deduction, which for tax purposes means now they have to pay tax on $500,000, even though they had zero taxable income, or net profit, right? So this was not good, right? And there were a lot of software companies in this situation, and other companies that do R&D as well, where they were finding themselves with a lot of phantom income that they were having to pay tax on, right? So there was a lot of lobbying happening. There was a lot of letters being written to congressmen and senators. Hey, you guys have to fix this 174 problem, because I think actually it was an unintended consequence of whatever else they were trying to fix in the law. So the good news here with respect to 174 is that in the new BBB is that it does fix this problem, and it allows the entrepreneurs, what they call small entrepreneurs, right? So someone whose gross revenue was less than 26 to 31 million, depending on the year that we're looking at, but say 26 million in 2022. So if you fall into that bucket, you're a small business, an entrepreneur with a small business, less than 26 million of revenue. You can retroactively go back to 2022, 2023, and 2024 and amend those tax returns and get rid of the piece that you had to capitalize and amortize and just take those deductions, right? And reduce your taxable income by whatever you had to capitalize. And moving forward, they fix it to say you don't have to capitalize those anymore. You get to immediately expense R&D expenses, whether it's salaries and wages or servers or subscriptions or whatever qualifies as an R&D expense. You get to expense those in the year that they're incurred, and so that's huge. It's also huge because even though they didn't really change a lot about Section 41, which is the R&D tax credit, so the R&D tax credit kind of works the way that they didn't change anything in the big beautiful bill with the way that it works. But the way that it works is that it's a percentage of what you call R&D expenses. So if in 2022, 23, and 24, you were incentivized to call way less of your expenses R&D expenses, it means that your R&D credit was way less. Now you can go back and fix all of that. You can claim the credit, and moving forward, you can maximize your R&D expense. Obviously it has to be real and it has to be justifiable and documented. But whatever that number actually is, you can base your R&D credit off of that moving forward, and that's going to help you maximize the R&D credit too. So they definitely did a really good job. They listened to the lobbyists. They listened to all the letters that were written. They did a really good job in the One Big Beautiful Bill to fix the 174 R&D problem.
Wow. Yeah, that's huge. That's
Yeah.
awesome. Um, how does the OBBB affect the SALT deduction?
Great. Yeah. So the SALT deduction stands for state and local tax, right? So state and local tax, some people call it the blue state tax because that's where a lot of these taxes are. Although I think that there's only like 6 taxes that have no state and local tax. But state and local tax is typically a deduction on your personal tax return. And in 2018, it was limited to $10,000. And so this affects a lot of people. If you're in California or you're in New York or you're in, whatever state charges state income tax, and that the state income tax that you pay is more than $10,000, you're just not able to deduct it, right? There's a thing we'll talk about in a minute where you maybe can, but for a lot of people, especially if you're just a W-2 employee, you're not an entrepreneur, you don't own your own business, you're a W-2 employee, you're making, you know, $1 million a year and paying $80,000 in state and local income tax, you can only deduct 10,000 of the 80, right? So people have had a very big problem with this since this law was passed. Okay, so I know Trump ran on the platform to get rid of the SALT cap, right? The $10,000 cap. So the bad news is that they didn't get rid of the SALT cap. The good news is that they did increase the cap, right? So currently it's at 10,000, effective in 2025. It's going to go up to 40,000, right? So that's going to help a lot of people. That cap does phase out between 500 and 600,000 of adjusted gross income for married filing joint. So if you make more than 600,000, then it's still going to be a $10,000 SALT cap, or SALT deduction that you're going to be able to take. But for anybody that's in that like 3 to 500,000 range, which is where your state income tax would probably be more than 10, then that's really going to help you. You're going to be able to deduct some state and local income tax that you weren't able to deduct before. For people who are above a $500,000, and that income is coming through their small business, right, or whatever pass-through business they have, what we typically do in that case is not claim that tax on their personal tax return. Instead, we claim it on the business side of the tax returns, right? It's called pass-through entity tax. Most states have created this workaround, and actually, you can go back and look at all the conversations that were being had in the Senate and in the House regarding this particular issue. They wanted to do away with this pass-through entity workaround, but they didn't, right? So they ended up keeping the existing pass-through entity tax workaround. So if you have a small business, you can pay that state income tax through your business state tax return, take the deduction there, right, which passes through to your business income return, your federal income return, reduces the pass-through income tax on your individual return. You don't pay the tax on the individual return to the state and local government. You paid it on the business. And so there's no $10,000 cap or $40,000 cap. There's no cap. That's how you maximize the deduction related to the state and local tax for pass-through entities. So we do that for a lot of clients. And actually, I don't think this question is on our list, but one question that we get a lot is, do we do tax work for clients outside the state of Florida, right? And the answer is yes, right? So even though we're primarily based in St. Augustine, Florida, and we serve lots and lots of clients in the Northeast Florida area, we serve clients all over the country. And I'm currently recording with you right now in North Carolina, and we have a lot of clients up in North Carolina, which is one of the reasons I spend a lot of time up here. But we work with clients in California and New York and New Jersey and Minnesota and Arizona, and a lot of clients in Texas. And most of those states have state and local tax that we have to deal with. So we're very familiar with how that works in all these different states, and want to make sure we maximize those deductions for our entrepreneurial clients there too.
Yeah. Love it. I was reading and I read that there's a way for small business owners to avoid all of the gain on the sale of their businesses, and that the OBB actually makes this loophole even better. So can you tell me a little bit more about this?
Yeah. So this is a tax provision. So how do we exclude sometimes all of the gain on the sale of a business, right? And it's a not a very well known code section, I would say. I've had very few clients over the years come to me and say, hey, do you know anything about Section 1202 and how I can make that work for me? Um, but it is a thing, right? So Section 1202 does allow you to exclude the gain from the sale of your business based on certain setup and certain rules and certain limitations, right? So uh, let's maybe talk about how the rule has worked up to this point, and then we can talk about how the OBBB has changed that, right? So up to this point, Section 1202 gain exclusion basically said your entity has to be a C corp. It has to be a C corp, right? It cannot be an S corp. It cannot be a partnership. So it cannot be a pass through entity. Most of the clients that we deal with are pass through entities, right? That most of the clients we work with. Very few are C corps. Mostly they're not C corps because they don't want the double taxation that is typical of a C corp. Okay. Um, but in some cases, a C corp makes a whole lot of sense. Like if you think you're going to go public at some point, you might want to start off as a C corp. If you're going to be a software company and you're going to have lots of licenses and intangible assets, and it's easier to sell the entity than it is to sell the assets, it might make sense to be a C corp to be able to utilize this rule. So there's a bunch of different business reasons and maybe a handful of tax reasons why someone might want to be a C corp, but it is one of the requirements of Section 1202, right? So okay, you're a C corp. The owner of the investment that's being sold, right, the stock, let's just call it the stock, has to purchase that stock from the C corp, right? So I can't purchase it from you, Kaylee, and then subsequently exclude that gain on the stock that I bought from you. I have to buy the stock from the company, right? Or it has to be issued to me from the company. Um, Also, the assets, the gross assets of the C corp have to be less than 50 million at the time I acquire my stock, right? So these are relatively small companies, right? I mean, some people may listen to this and say 50 million, that's a pretty big company. And it is, but we're basically saying this doesn't apply to big companies like Apple and you know every publicly traded company that you can think of, right? They all have assets far more than 50 million. So these are relatively small companies, and of course all the small companies, anything under 50 million qualifies. You have to have held the stock for 5 years at a minimum, and really that's pretty much it. So if you are satisfy those boxes, if you check all those boxes, and then you sold your stock, you could exclude the greater of $10 million of gain or 10 times your cost basis, whichever is greater, right? So if I paid, $100,000 to buy into this C corp, right, and later sold this stock that I had bought for 100,000 for 5 million, I can exclude all 5 million. If I paid 100,000 and sold it for 12 million, okay, which would be a heck of a return, then I can exclude 10 of the 12, right? Because that's the greater of 10 million or 10 times the cost basis. We could go through a bunch of different examples like that, but I think you get the picture. So what did the OBBB do to enhance that? Well, what they did is they increased the gross asset test from 50 million to 75 million, right? So they've kind of redefined a small business. 50 million's been in the code for many years, like 20 something years. So they changed that from 50 million to 75 million. So there's more businesses that are eligible for this. It increased the gain exclusion from 10 million to 15 million, right? So it's still 10 times original cost basis, greater of 10 times original cost basis, or 15 million now instead of 10. So you can exclude up to 15. Um, and then it also created this kind of tier-based holding period system. So if you hold it for 5 years, you can exclude 100%. But there were instances where people couldn't hold it for 5 years. They were a minority owner. The company was going to sell. They had to sell. They didn't own it for 5 years. They didn't get to exclude any of their gain, right? Now, if you've held it for 3 years, you can exclude 50%. If you've held it for 4 years, you can exclude 75%. And at 5 years and above, it's 100%. And so that's pretty big, right? Because fairly often there are people, I mean, we've worked with clients who've been bought out by private equity. They own stock in a C corp, and 3 years later they're gonna do another sale, right? Well, in the old rules, they would have to pay a tax on all that gain. In the new rules, they could now exclude 50% of that gain, right? So that's pretty cool. And the last thing that the OBBB did is it made this section 1202 permanent. I wasn't even aware that it had a sunset provision on it because it's been around for so long, but it did make all of these rules permanent in the code. So yeah, it's pretty exciting. Yeah. And I think for people out there who are, it's worth looking at when you're starting a business and thinking about what your exit strategy is to at least know about 1202 and how it works, right? Because it may be that that's the exit you want to work towards. And, you know, if you don't know about it, then you may just be leaving a bunch of tax money on the table.
Yeah. Wow, that's awesome. Those are all the questions I have in terms of entrepreneurs and how the bill, affects them. I'm super excited on our next episode to go into how it affects individuals. But do you have anything else that you want to touch on before we hop off?
Yeah, I mean, there's a lot of other little provisions in there that affect entrepreneurs. Probably nothing else that we need to talk about on this. But without a doubt, when we're starting to prepare 2025 tax returns and do planning for 2025 later this year, we're going to be looking at all of those little things too, in addition to these big ones that we've talked about today, and just doing everything that we can to help our clients minimize the tax that they're paying using the new rules. So,
Yeah,
yeah,
awesome. Well,
nice.
thanks for coming on today. I'm excited.
Awesome. Well, then I'll see you later and we'll talk about individuals.
Sounds good.
Okay.
Bye.